On today's global webinar on IASB's exposure draft on regulatory assets and liabilities. This webinar is jointly organized by Accounting Standard Board of the Institute of Chartered Accountants of India, which now I call for brevity ICAI, and International Accounting Standard Board, IASB. At the outset, I thank you all our esteemed guest panelists and participants for sparing their valuable time for this webinar. We are excited to see you all on one e-platform. Friends, the idea of this webinar is to discuss the exposure draft on the proposed standard on the regulatory assets and liabilities. I promise, friends, this is going to be a very interesting and an exciting deliberation and discussions. Friends, before I invite our dignitaries for the welcome speech, I must apprise you of the galaxy of dignitaries who have won accolade in their respective fields and are with us today. So I'm going to name all the dignitaries who are there today. I request them just to get recognized when I call out their name. The first one is our President of ICI, CA Nihar Jambusariaji. Next one is Vice President ICI, CA Dr. Debashish Mitra. Then Chairman Accounting Standard Board, ICI, CA MP Vijay Kumar. Then Vice Chairman Accounting Standard Board, ICI, CA Dr. Sanjeev Singhal. Then CA Dr. S.B. Zaware, Chair AOSSG. And then we have a esteemed guest from International Accounting Standard Board and Antarka. Then we have Mariela, again a technical staff from IASB. Then we have CA Nina. Then we have one more Mr. Technical staff Raghava Tirumala from IASB. Then we have the eminent speakers, CA Nina Goyal, CA Amit Chugh, again, an eminent speaker, and one more eminent speaker, Shri A.K. Gautam ji, Director of Finance, NTPC, and Mr. Hemant Goyal, Chief Financial Officer, Tata Power. Now it's time for me to introduce and invite CA MP Vijay Kumar ji, Chairman.
Agnesh, sorry for interrupting.
Yeah.
We have two other very important guests, board members of IASB. I'll take the liberty of interrupting and invite Jingchao Lu and Rika Suzuki. Both of them are IASB board members who are kind enough to join us today.
Thank you, sir. Thank you very much. Thank you. So now it's I introduce and invite CA MP Vijay Kumarji, Chairman Accounting Standard Board. CA MP Vijay Kumarji is the Chairman Accounting Standard Board of ICI and Vice Chairman of an expert advisory committee and a valuation standard board of ICI. Presently, he is serving as a CEO of a listed company. He has an extensive experience in the field of financial reporting and corporate governance. He has a special interest in the area of academic education and imparts training in accounting, finance, and author 10 popular titles in accounting standards, auditing standards, and law for students and members. I don't know how many numbers of students MPG would have imparted training for, but it must be at least more than 10,000 students, sir, if I'm not mistaken.
Yes,
Yes. So it's over to you now for your welcome speech, sir.
Thank you, Agnesh. Greetings to all. Trust all are safe and your near and dear ones healthy. At the outset, sincere thanks to International Accounting Standards Board for jointly hosting the outreach event on the exposure draft on regulatory assets and liabilities to replace the existing IFRS 14 on regulatory deferral accounts. The IASB team has been exceptionally supportive to India's work and contribution in development of IFRS over time. My personal thanks to our Institute President, Nihar Jambusariaji, our Vice President, Dr. Debashish Mitra ji, who himself is an acknowledged expert on US GAAP and IFRS with a doctorate in this area, for their consent to address us at this event. And thanks to the board members of IASB, of whom Ann Tarka is going to introduce the topic today. And I very heartily welcome the other two board members, Jing Chao and Rekha Suzuki as well, the technical staff of IASB, the panelists, and my mentor, Dr. Zavare, past ASB chairman, who have accepted our invite to be part of today's webinar. I heartily welcome each of you to the event, and I'm thankful to the Vice Chairman of ASB, Dr. Sanjeev Singhal, for coordinating all aspects of this event and moderating the panel. Thank you for joining us despite being a very busy period. For all of you actively engaged in preparing or auditing the financial statements for the year which has just closed 31st of March. On a personal note, Tirumala Raghava, who is one of the IASB staff members who will address us today, is from India, and I'm happy he is actively engaged in this project. It has been my personal interest that we should have more from India who will actively work at IASB, and more engagement from Indian accounting fraternity, contributing to the development of robust IFRS, considering the experience and depth of knowledge we have in India. We are a jurisdiction with highest number of entities following Ind AS, which is the IFRS converged standards, about 30,000 companies across diverse sectors, manufacturing, services, and others. The sixth largest economy in the world, and ICAI being the second largest accounting body in the world, we also have the responsibility to be actively engaged in the development of IFRS and, importantly, its consistent application. In the interest of time, and given that we have very good set of speakers who are subject matter experts, I am not sharing my thoughts on the exposure draft. In our endeavor to ensure high quality, transparent financial statements, we are committed to stay converged with IFRS, and it is imperative that we share all our concerns at the exposure draft stage. I conclude my welcome address, inviting each of you to share your thoughts on the exposure draft today and subsequently through mail to the Accounting Standards Board, with more specific focus on issues in implementation of the exposure draft in India. Hearty welcome once again. Stay safe, stay accountable.
Thank you, Chairman, sir. And before I invite and introduce President ICAI CA Nihar Jambusaria, I am giving his brief introduction. Mr. Jambusaria is a man of professional wisdom, vision, and a strong organizational skill with a firm belief in all-round inclusive growth of ICAI. He has been committed to ICAI, and in his tenure of 37 years of post-qualification experience, he has served at least 21 years for ICAI, whether at the regional level or at a central level. He hails from Mumbai and is seasoned professional. He is from Mumbai and currently associated with an industry. A blend of erudition, experience, foresight, and technical expertise, and a professional excellence worth emulating, and a fellow chartered accountant from Mumbai, C.A. Nihar Jambusaria has joined as vice chairman, as a chairman of WLC in 2004 and 5. And before that also, he was very much actively associated with the activities of ICAI. C. Jambusaria is now the chairman of all standing committees, including executive, finance, and examination committees, besides being an ex-officio member of non-standing committees and editor of ICAI Journal. The chartered accountant C. Jambusaria is director of ICAI Registered Value Organization RVO, and also the representative from the ICAI RVO on the committee to advise valuation matters. CA Jambu Surya is the chairman of ICI Research Wing, ICI Accounting Research and Foundation and Extensible Business Reporting Language (IXBRL) in India. He has made a noteworthy contribution in whatever capacity he has served the profession, particularly as a Vice President ICI, Chairman of India's Implementation Committee of ICI, International Tax Committee, and various other important committees, Board of ICI. CA Jambu Surya is a member of Professional Accountants in Business PAIB Advisory Group of International Federation of Accounts IFAC. He is in the capacity as the president of ICI, would also be representing ICI on International Integrated Reporting Council IRRC and the board of the South India Federation of Account SAFA. He is also served as a member of SAFA committee on PAIB. He has been a very prolific speaker on the national and the international forum. As an avid academician and an orator par excellence, he has attended and contributed to numerous national and international seminars. He has addressed more than 900 seminars, conferences, and so far covering the various subjects of professional interest like direct tax, accounting standards, international tax and professional development, and the like. With a focus on the innovations, and the niche establishment he intends to translate his passion for the inclusive growth of the profession through the transnational agenda that current paradigm warrants. And with this, I invite President ICI CA Nihar Jambu Surya ji. Please welcome for your welcome address, Mr. Jambu Surya.
Thank you, Yagnas, for a very generous introduction in your very unique style as usual.
Thank you.
Thank you so much.
My pleasure.
Good afternoon, good morning, good evening, depending on from where you are attending. Vice President of the Institute, CA Dr. Devashish Mitra, the Chairman ASB, CA MP Vijay Kumar, Vice Chairman ASB, CA Dr. Sanjeev Singhal, Chair AOSSG, CA Dr. SB Zavre, all dignitaries from IASB and panelists from India and participants. I'm sure that in spite of the spread of COVID, particularly in India, you are all safe and healthy. Let me at the outset congratulate the Accounting Standard Board for organizing this virtual outreach on IASB exposure draft on regulatory assets and regulatory liabilities, which will be replacing IFRS 14. And every time there is an exposure draft from IASB, the ASB is very active and quick to organize such outreach for the knowledge of the members in India and to seek their inputs. I'm sure that this objective will be well achieved. The IASB members will explain the draft, and there are panelists from India who will not only understand but raise issues on this exposure draft, which will enable IASB to incorporate the concerns when the draft is finalized. ICAI has always been very proactive in the standard setting activities of IASB. And the fact that ASB Chairman CMP Vijay Kumar has been nominated as member of IFRS Advisory Council and also as a member of SME Implementation Group. And the past chairman of ASB and current chair of AOSSG is also contributing towards the standard setting activities. I have seen CA Dr. Sanjeev Singhal taking very active interest whenever there is exposure draft. Even he takes such active interest, gives inputs and organizes outreach programs. And our members are always benefited because concerns from India are addressed. Now that In India, whatever is done at IFRS level is being virtually accepted. So before the drafts are finalized, this kind of inputs which may go into finalization of the draft would be very useful to the members when they implement these standards in India. So once again, congratulations for organizing this outreach program, and I'm sure that panelists and participants will actively participate, if not in the webinar itself, even afterwards by communicating the issues and the probable solutions, they will actively participate. Thank you so much for inviting me. It was a pleasure being amongst you. Thank you so much.
Thank you so much, sir.
Thank you, President, sir. Thank you very much, sir, for a very invigorating speech. Friends, I must share something with you. There are 400 participants as of now, and that too for a highly technical, industry-specific standard, because the regulatory assets and liability is not applicable to all in one. It is applicable to few select segment. But despite this, there's the participants have evinced the interest, and we are all grateful to the participants once again on behalf of IASB and on behalf of ASB ICI. And now it's my pleasure to introduce and invite for his welcome speech none other than Mr. Vice President Debashish Mitraji, but I must introduce him before he delivers his welcome speech. And you'll see it very well that Vice President Debashish Mitra sir is a very prolific and avid speaker, and he's joined ICI in 2016-19, and this is his second tenure. And with great vigor and enthusiasm, he has been serving the accounting profession for more than 34 years. Mr. Vice President, when ones look at you, they wonder, you served 34 years. You look very young today. Academically edited, Dr. Mitra. Oh, Dr. Mitra is a senior practicing member and also cost accountant, company secretary. Oh my God, and holds a master degree in commerce, law graduate, and a qualified information system auditor. Thank God is a full stop now. With a keen interest in the academic research, he is a doctorate in the complex and intricate area of the accounting standards and has been awarded PhD on the topic, a critical study on the select Indian GAAP, US GAAP, INIS, and IFRS. Persuasive and an intense trainer, he is renowned for the interactive deliberations in the international financial reporting standards and corporate laws. He has trained several officials for the corporate and non-corporate entities as well as central and state government organizations. He is an avid speaker. As an accomplished professional having immense knowledge of trade and industry, he has served as an active member of several prestigious boards, forums, and institutions in India, namely Quality Review Board established by Government of India, Board of Extensive Business Reporting Language India, and the Board of Governance Assam Downtown University. He has been representative of ICI in Uday Kotak Committee on the Corporate Governance set up by SEBI, as well as a committee set up by the Ministry of Corporate Affairs for revision of CARO. Dr. Mitra is also the member for the Committee on the Corporate Governance Guidelines for the Insurance in India, and is also the Committee of Drafting Appendix to the Investigation Manual of the Serious Fraud Investigations Office, SVIO. On an international front, he has been the chairman of the Committee of the Education, Training and CPD of South Asian Federation of Accountants, SAFA, and members of the audit groups of Confederation of Asian Pacific Accountant, CAPA. He has also served as a member of SAFA Committee on Auditing Standards and Quality Control. Dr. Mitra has held several key positions in ICI, Chairman, Board of Studies of ICI, Director, Accounting Research Foundation, and he has held so many positions. So if I say so much about that, that will consume the all time. So I'm shortening my introduction, Dr. Sir, and invite you for your speech. Welcome, Vice Chairman, sir.
Mr. Desai, thank you very much. I would like to, just repeat what the President just said when you had introduced him for a very pleasant, even though a bit elaborate introduction. Good evening, everybody. The President of the Institute of Chartered Accountants of India, and of course my council colleagues, MP Vijay Kumar, CA Dr. Sanjeev Singhal, and Shri Zavde sir, and everybody else from IASB, all the panelists. You have been already named by the President, so I would not like to repeat. This is my 6th year in the council. And the first 3 years, I spent sitting next to CA Dr. S.B. Zavde. And he was the chairman, Accounting Standards Board. And I could see, and I'm telling you of my experience in the first 3 years, I could see how much he was, committed to the development of the IFRS. In India, we call them Indies. And how much he was interested in working hand in hand with IASB. And you see, it left a deep impression, not only him, but the Accounting Standards Board and the Council of the Institute of Chartered Accountants of India. After he had ceased to be a council member because, you see, of the expiry of his term, in came MP Vijay Kumar, who was the vice chairman when Zavde sir was the chairman, along with his deputy Sanjeev Singhal, who also happens to be a PhD. And this is for those of us from IASB who are listening to me. And the commitment to working hand in hand with IASB continued with renewed vigor. You see, when India's 115 relating to revenue from contracts with customers came in, when India's 116 on leases came in, there was so much of discussion on the IFRS and the standards developed by IASB. And at the council, we are so happy working very closely with International Accounting Standards Board in developing these standards. Please note, the standards that we develop, get statutory recognition. So these are, very, very important standards. And I am very happy to note that today we have this outreach program on the regulatory exposure draft on the regulatory assets and liabilities. And as Yagnesh had said, this topic is highly technical. But if you have more than 400 wanting to attend and enjoy the sharing of thoughts, then you know that the Institute, to a great extent, has been successful in generating interest amongst our stakeholders about this very important topic of accounting standards. At the Institute, once pandemic struck, we have had so many virtual programs to popularize the accounting standards. And let me tell you, even though these topics, the accounting standards, auditing standards, these topics are a bit technical in nature, over a period of time, because of the insistence and enthusiasm of Accounting Standards Board and Audit and Assurance Standards Board of the Institute, we have been successful in popularizing these standards. I am extremely happy and extremely pleased to see so many enthusiastic faces, who are willing to share their knowledge or willing to be enlightened by others on this very important topic. I congratulate IASB and, of course, the Institute of Chartered Accountants of India, my alma mater, for having joined hands for this outreach program. And I'm sure we will have more such programs in times to come. Once again, I wish both these institutes the very best in all their future endeavors. And I hope we will go ahead, hand in hand, shoulder to shoulder, for the benefit of the profession. Thank you very much.
Thank you, Vice President, sir. Yes, indeed, the both board will go hand in hand and do the miracle. And now it's my pleasure to introduce none other than the Vice Chairman, Accounting Standard Board, Dr. C.A. Sanjeev Singhal. C.A. Sanjeev Singhal is Vice Chairman of Accounting Standard Board. He has completed BCom honors from SRCC College, being the university topper, AMCOM Department of Commerce from Delhi School of Economics. He's obtained the PhD in the International Finance from the Faculty of Management Studies, Delhi. He has served his profession with 20 years of total experience with some key positions as the Vice President, Finance at Cybermedia, Executive Vice President, Finance at RARL, Vice President, Jubilant Life Science, etc. And right now he's working for one of the big fours company in India. With his extensive knowledge, he has over 14 books published by the leading publishers, including Bharat Law House, CCH, Lexis and Nexis, Bloomsbury, etc. on Indies, IGAP, Companies Act 2013, Revised Schedule 6, etc. to his credit. Sir, I wonder where do you get time from? He has also published several research papers published in leading journals and ICA publications and the leading India's newspapers. He has contributed towards resolving industry and professional interest issues. He has also contributed as a member of CII, National Financial Reporting Committee, and Chairman CII. With his astounding speech, he has made over more than 450 seminars on accounting standards, Indies, IFRS, IPSS, and Revised Schedule 6 and Schedule 2 to Companies Act 2013, accounting standard, etc. across India, Bhutan, Nepal, Bangkok, Dubai, etc. And now it's over to Dr. Sanjeev Singhal. Vice Chairman ASB, sir, is all yours.
Thank you very much, Yagnesh Bhai. And since the Honorable President and Vice President has already spoken about the style in which you handle the program, and you are almost our permanent master of ceremony. I remember in the last year exposure draft program also, you were the master of ceremony. The Honorable President ICI, CA Nihar Jambusaria ji, the Honorable Vice President ICI, CA Dr. Devashish Mitra ji, who has himself done his PhD in IFRS, my chairman in the Accounting Standard Board, CAMP Vijay Kumar ji, our AOSSG chairman, our very own CA Dr. S.B. Zavere, the esteemed board members and the staff members from the International Accounting Standard Board, and the esteemed panelists and the participants. This is really indeed a matter of pleasure and pride that India is hosting this exposure draft event. And let me tell you, this IFRS 14 is not new to India. We have a guidance note on the rate regulated entities. And when I was going through this exposure draft, many of the provisions are already being used. And since we have the panelists who are from the power sector, two are from industries who are using it, and two are the auditors. So, India this standard is not going to be new to India. And this standard, when I really looked at the proposal, I was really, overwhelmed with joy, because our aim is that the company should reflect the total compensation to which they are entitled for goods or services supplied in a period as part of their reported financial performance for that period. Because today, there could be a mismatch without this standard. Maybe if you are able to recover a higher charge, or if you are liable to reduce a charge in the future, then you are not reflecting the true performance in this period. So there was a gap in this international gap, which was required to be filled. And this exposure draft, I just hope that it will take care of the differences in timing which arise if the period when a company can include compensation in the regulatory rates is different from the period when the company supplies the goods and services. And we see so often it in India as well in the regulated sector, particularly when I have to talk about the DISCOMs. So I think this is very, very relevant, and the technical presentation which will be made by the IASB, our esteemed guests from IASB, followed by a panel discussion, I'm sure will be very, very useful, and IASB will take back some very useful comments on the proposals on this very important IFRS 40. With this, I would like to hand it over to Yagnesh Bhai for the further proceedings. Thank you very much.
Thank you, Vice Chairman, sir. Thank you very much, sir. And now it's my turn to introduce the esteemed members from IASB. Let me introduce Rick Suzuki and Jeon Q. Leo Sam and Tarka members IASB, Marila Aizren, technical staff IASB, and Raghava Tirumala, technical staff IASB. So let me give a brief introduction of Anna Antarka, who joined IASB from the University of the Western Australia as a business school, where she was accounting teacher and a researcher since 1966 and a professor in 2011. Professor Tarka served as a member of Australian Accounting Standard Board from 2014 to 17 and was the research director for the IASB from February 2017. She was an academic fellow of IFRS Foundation from 2011 to 2012. She has authored the textbooks on accounting and written a wide range of research papers related to IFRS standards, for which she has received many awards and accolades. Professor Tarka is an active member of the International Accounting Academic Community, having served several boards and committees. She's qualified as a chartered accountant back in 1985 and has PhD in accounting from the University of Western Australia. We have another technical staff, IASB, Marila Aizren. Marila is a technical staff at IASB. She was previously working with a joint venture project which led to the publication of IFRS 11 as joint arrangement. I think this was named as IFRS X codename, Fair Value Measurement, Accounting for Dynamic Risk Management and Disclosure of the Initiative Projects. Prior to joining the organization in 2007, Marila worked as a financial consultant in the group in one of the big four companies in Spain. She also holds a bachelor degree in the business administration from the University of Pompeu Fabra in Barcelona and the master's in finance from London Business School. We have one more technical staff members from IASB, Raghava Tirumala. Raghava Tirumala is a technical staff at IASB, and he previously worked as a business combination under the Common Control, one of the most sought after standards and deliberated standard transition group for the revenue recognition, clarification to IFRS 15, and goodwill and impairment projects. He is a qualified chartered accountant. He qualified CA in 2002 and a fellow member of ICAI. Very proud to hear that you are a fellow member of ICAI. So now I welcome all dignitaries from IASB for their opening remarks and for their key proposals, for their overviews of the key proposals on the proposed exposure draft. Friends, you hear from them. It's going to be very exciting. Take my words, and it's over to you, IASB team.
Thank you so much. Thank you for all those words of introduction, your kind introductions, and thank you for joining us today. Thank you so much to ICAI for hosting us today. We are very, very pleased to be here and speak to you about our project. We have been introduced, and Tarka, I'll be joined speaking today with Mariella and Raghava. Also, we have Rika Suzuki and Jen Xiao Lu, board members, with us today. Before we begin, I would just like to note that the views we express in this webinar are our personal views, and they are not necessarily the views of the IAS board or the IFRS Foundation. This slide shows you the material that we'd like to cover today. We will split the discussion into three broad areas. First, I will talk about the problem that the board is trying to solve and how the board proposes to solve it. Raghava and Mariella will then provide an overview of the main proposals. And finally, I'll talk about the likely effects of the proposals. So, first of all, let's understand the problem that the board is trying to solve. This slide gives us a summary or an overview of the problem. So the entities for which the exposure draft applies are those that are subject to rate regulation. Now, rate regulation establishes how much compensation the entity is entitled to charge customers for the goods and services supplied. Rate regulation also establishes when the compensation can be included in the rates or prices charged. So by when, we mean what period. The exposure draft calls this compensation total allowed compensation, You can see that in the bottom left-hand box. So total allowed compensation relates to the full amount of compensation for goods and services supplied that a regulatory agreement entitles an entity to charge customers through the regulated rates. Now, this can be when either in the period when the entity supplies the goods and services or in a different period. So typically, the compensation for goods and services supplied is charged to customers through the rates for the period in which the entity supplies those goods and services. However, in some cases, there's a difference in timing. The regulatory agreement requires the entity to include some of that compensation in the regulated rate for goods and services supplied in a different period. If these differences in timing occurs, the amount of revenue the entity recognises in a period, applying IFRS 15, revenue from contracts with customers, can include compensation for goods and services supplied in the past or that will be supplied in the future. However, it may not include all the compensation that an entity is entitled to for the goods and services supplied in the period. And this is because some of the compensation was already included in the rates charged in the past or will be included in the rates charged in the future. Now, to understand all of that, let's look at a simple example. In this example, let's assume the regulated rate an entity charges for goods supplied in year one is based on estimated input costs of 100. But the entity incurs actual input costs of 120. Let's also assume that the regulatory agreement gives the entity the right to add the under-recovery of 20 to the input costs in the rates to be charged in year two. So, applying IFRS standards, for year one, the entity recognises revenue of 100 and actual input costs of 120. The entity is entitled to compensation of 120 for the goods supplied in year one. Looking at year two, in this example, the regulated rate the entity charges for goods and services supplied is based on the input costs of 100 for year two and the under-recovery of 20 of the compensation from year one. Therefore, the amount of revenue the entity recognises in year two will reflect compensation of 120. But the compensation of 20 included in the revenue in year two is actually part of the compensation for goods supplied in year one. So this example illustrates that without information about the difference in timing that relates to the 20, investors won't understand the following. They won't understand that the revenue in year one does not include the compensation of 20 for goods supplied in that year. And they won't understand that the revenue in year two includes compensation for 20 that relates to goods supplied in year one. So this is what we see as the problem. When there are these differences in timing, the IFRS financial statements do not provide sufficient information for users of financial statements to completely understand the relationship between revenue and expenses, for example, the operating profit ratio. It is also difficult for them to understand what portion of this fluctuation in the revenue and expense relationship is because of differences in timing. So in our example, users would not know that the increase in revenue from year one to year two of 20 is only because of a difference in timing. Users may be obtaining information about differences in timing from other sources and then making adjustments in their cash flow projections. But this just makes it unnecessarily difficult for them. So let's look now at the solution that the board has proposed. Firstly, differences in timing are associated with rights to increase or obligations to decrease future regulated rates. So if a regulatory agreement requires part of the compensation for goods and services already supplied to be included in future rates, then that difference in timing is associated with a regulatory asset. Similarly, if regulatory rates already charged include compensation for goods and services to be supplied in the future, that difference in timing is associated with a regulatory liability. Now, we'll just explain further these definitions of regulatory asset and regulatory liability in more detail as we proceed with this session. The board has concluded that regulatory assets and regulatory liabilities meet the definition of asset and liability as per the conceptual framework for financial reporting. So the problem of insufficient information about differences in timing that I've just been referring to can be solved best by an entity recognizing regulatory assets and regulatory liabilities in its statement of financial position, and then also regulatory income and regulatory expense in the statement of financial performance. The effect of recognizing regulatory assets and regulatory liabilities is that the entity's reported financial performance for a period would reflect the total allowed compensation to which the entity is entitled for the goods and services supplied in that period. If we go back now to the example, we can use this example now to illustrate the proposals. In year one, the entity would report regulatory income of 20 to reflect the compensation for the goods supplied in year one that has not been included in the rates for that year. And then also a regulatory asset of 20 to reflect the right to add the amount in setting the rates for year two. Then looking into year two, in year two, the entity would report regulatory expense of 20 to reflect the fact that the rates charged in year two, and hence the revenue for that year, includes the compensation for goods supplied in year one. In year two, the entity would report a zero regulatory asset to reflect the recovery of the amount of 20. So with this information provided in the financial statements, users of financial statements will have a sufficient basis to understand more completely the relationship between expenses and revenue, and also to understand how much of an increase or decrease in revenue from one period to another is because of these timing differences that we've been discussing. Now, with all the information that users would have once these proposals are applied, they don't have to worry about making adjustments for differences in timing when making their cash flow projections. Now, I hope that's been a useful introduction for you. I'm now going to hand over to Raghava and Mariella to take you through the main proposals.
Thank you, Anne. It gives me immense pleasure to be sharing this e-stage with my teacher, MPV sir. So with that, I'll proceed with first discussing the board's proposals on the scope of the exposure draft. So the exposure draft simply says that an entity shall apply the proposals to all its regulatory assets and regulatory liabilities. It then points out that regulatory assets and regulatory liabilities as defined in the exposure draft exist only if three conditions are met. First, the entity has to be party to a regulatory agreement. The exposure draft defines a regulatory agreement in a somewhat broader sense as a set of enforceable rights and obligations. The regulatory agreement need not always be titled as a regulatory agreement. It can be a licensing agreement, a service concession agreement, a statute, legislation, or regulation. What is important is that the entity has legally enforceable rights and obligations. The second condition is that the regulatory agreement establishes the basis for how the entity must set the regulated rates charged to customers. The third and the last condition is that the regulatory agreement creates differences in timing, thereby creating regulatory assets and regulatory liabilities. If any of those three conditions are not met, an entity has no regulatory assets or regulatory liabilities as defined in the exposure draft. In assessing whether an entity has a regulatory asset or a regulatory liability, the board concluded that an entity need not consider, for example, what the objective of the rate regulation is, whether aspects of the entity's activities other than rate setting are regulated, or whether there is a regulator with specified characteristics, so on and so forth. When developing the definitions of a regulatory asset and a regulatory liability, the board observed that in addition to the three conditions that you see on the slide, there was no reason to include any other feature in addition to the three, because any feature other than these three need not be present for a regulatory asset or a regulatory liability to exist. Now, please note that the regulatory asset and regulatory liability is not just a number in the balance sheet or wherever it is in the financial statements. The regulatory asset is a right created by the regulatory agreement, and the regulatory liability is an obligation created by the regulatory agreement. So see them as rights and obligations rather than as just numbers. Furthermore, requiring the presence of any other feature other than these three would not result in a distinction that produces information more useful to users of financial statements. If the exposure draft were to specify any other feature, that would limit the proposed scope of the model to cover only a subset of entities that have regulatory assets and regulatory liabilities. So I will now take you through the definitions of regulatory asset and regulatory liability in some detail. An entity has a regulatory asset when total allowed compensation for the goods or services supplied in a period has not been fully included in the regulated rates charged during that period, and consequently has not been fully included in the revenue recognized during that same period. As a result, the entity has an enforceable present right to add that unrecovered part of the compensation for goods or services supplied to the future rates the entity will charge customers. The entity would report that right as a regulatory asset with a corresponding regulatory income. Now, in the future period, when the entity charges customers a rate that includes the part of the total allowed compensation for goods or services supplied in the past, the entity would recognize revenue and would reflect the recovery of the regulatory asset by derecognizing it and accounting for related regulatory expense in the statement of financial performance. Therefore, a regulatory asset is defined in the exposure draft as an enforceable present right created by a regulatory agreement to add an amount in determining a regulated rate to be charged to customers in future periods, because part of the total allowed compensation for goods or services already supplied will be included in revenue in the future. In simple words, the incremental revenue in the future and therefore the cash inflows would not have arisen if the entity did not have a regulatory asset. Now, a question that anyone may have is what distinguishes a regulatory asset from a general right to increase future prices? Now, a regulatory asset is not a general right to increase future prices by any amount at any time for any reason. A regulatory asset permits an entity to increase future regulated rates, only by a fixed or determinable amount and only because of goods or services already supplied. An entity that is not subject to rate regulation typically has a general right to increase future prices by any amount at any time and for any reason. So although that general right to increase is less constrained than a regulatory asset, that right is typically available to all parties without significant cost. And as you may know, the conceptual framework explains that rights available to all parties without significant cost are typically not assets for the entities that hold them. So next on this slide, you'll see a few examples of differences in timing associated with rights that are regulatory assets. I will not go into in detail on each of these examples. So moving on, the regulatory liability arises when the regulated rates charged in a period and hence revenue recognized in that period include compensation for goods or services that an entity will supply in the future. So for example, an entity may be entitled to add in the rates charged in the current period an amount that pre-funds part of the total allowed compensation for goods or services to be supplied in the future. So that creates an enforceable present obligation for the entity to deduct the compensation already recovered from the rates the entity will charge customers in the future. So an entity reports that obligation as a regulatory liability with a corresponding regulatory expense. Now, in the future period, the entity fulfills the regulatory liability when it deducts the compensation already recovered from the rates it charges to customers. This means that in the future period, the entity recognizes a lower amount of revenue than it would have recognized had it not recovered compensation in advance. So the entity reflects the fulfillment of the regulatory liability in the future period by derecognizing the regulatory liability and accounting for the related regulatory income in the statement of financial performance. Therefore, a regulatory liability is defined in the exposure draft as an enforceable present obligation created by a regulatory agreement to deduct an amount in determining a regulated rate to be charged to customers in future periods because the revenue already recognized includes an amount that will provide part of the total allowed compensation for goods or services to be supplied in the future. So on this slide, you'll see a few examples of differences in timing associated with obligations that are regulatory liabilities. And I'm not going to go into the detail of each of these examples now. I will now take you through the concept of total allowed compensation for goods or services, which is at the heart of the proposals. Anne has already introduced the concept of total allowed compensation for goods or services. The exposure draft identifies three components of total allowed compensation. First, compensation for expenses that the entity incurs when supplying goods or services and that a regulatory agreement entitles the entity to recover. The exposure draft refers to such expenses as allowable expenses. So on the other hand, an entity will also be required by the regulatory agreement to pass through to customers amounts of any income that the entity earns, for example, profit on sale of asset. The exposure draft refers to such income as chargeable income. So the first component the exposure draft identifies is recovery of allowable expenses less chargeable income. The second component is the target profit, mainly in the form of regulatory returns on the amounts invested in the assets that the entity uses to supply the goods or services, or in the form of performance incentives, whether bonus or penalties. The third component is regulatory interest. I'll talk about it when I get to the next slide. So why does the exposure draft specify the components of total allowed compensation? The reason it does is to help an entity determine for each component, whether that component relates to goods or services supplied in that same period, or whether it relates to goods or services supplied in a different period, past or future. Now, the answer to that question would determine the period in which that component of total allowed compensation would be reflected in the statement of financial performance. Now, let us first start with amounts to recover allowable expenses less chargeable income. An entity would reflect compensation for allowable expenses less chargeable income in financial performance in the same period in which the entity reports the expense or income by applying IFRS standards. So if we go back to the example that Anne took at the beginning of this session, the input costs were an expense that the entity could recover in full through the rates. So the input costs were an allowable expense. The entity recognized input costs of 120 in year one in that example. Therefore, the compensation of 120 that the regulatory agreement entitles forms part of the total allowed compensation for the goods or services supplied in year one, regardless of when that amount of 120 is included in the rates charged to customers. So you saw in the example that of that 120, 100 was included in the rates charged to customers in year one, and the 20 was charged to customers in year two. So irrespective of when the amount is actually charged, that compensation of 120 relates to goods or services supplied in year one. Now, moving on to regulatory returns, the model establishes that regulatory returns that a regulatory agreement entitles an entity to add in the rates charged in a period form part of total allowed compensation for the goods or services supplied in the same period. This means that regulatory returns that an entity is entitled to add in the rates in a period would be reflected in profit in the same period. For one case only, the board concluded that returns to which a regulatory agreement entitles an entity to add in the rates in a period should form part of total allowed compensation for the goods or services supplied in a different period. So this is the case when an entity is entitled to include in the rates charged in a period returns on an asset that is not yet available for use because, for example, the asset is under construction. So in that case, the exposure draft proposes that any returns charged to customers during the construction period will form part of the total allowed compensation for goods or services supplied not during the construction period, but only once the asset is available for use and is used for providing goods or services in the future. So the board concluded this because during the construction period, the entity is not yet supplying goods or services with that asset, and therefore the entity is not entitled to any total allowed compensation because there are no goods or services that are being supplied. Now, this follows the principle that the board set and the principle which Anne explained at the beginning of this session. Now, moving on to performance incentives, a regulatory agreement may incentivize an entity to achieve specific performance criteria, for example, targeted levels of service quality, reliability, or customer satisfaction. Compensation in the form of a bonus or lower compensation in the form of a penalty would form part of the total allowed compensation for goods or services supplied in the period in which an entity provides the performance that gives rise to the incentive, regardless of when that incentive is included in the rates. Lastly, regulatory interest income or regulatory interest expense. So a regulatory agreement may compensate the entity for the time lag between the origination of a regulatory asset and its recovery, or charge the entity for the time lag between the origination of a regulatory liability and its fulfillment. The exposure draft uses the name regulatory interest for that compensation or charge. The entity reports regulatory interest income on a regulatory asset or regulatory interest expense on a regulatory liability as interest accrues throughout the life of the regulatory asset or regulatory liability. Now, the reason you see regulatory interest income or regulatory interest expense in a different color is that this component is the only one created by a difference in timing, with its amount being incremental and depending on the time lag. So the amounts of all other components are not affected by the time lag. They may be included in the rates in the same period when the related goods or services are supplied, or in a different period, but their amount will not change. Now, rate regulated entities may not know the term total allowed compensation for goods or services because it's a new term that has been coined for the purpose of this exposure draft. But some may be familiar with the term revenue requirement. Now, revenue requirement is typically the amount that an entity is entitled to include in determining regulated rates for goods or services supplied in a specified period. Now, some of you may have also heard the term authorized revenue instead of revenue requirement. Now, in contrast, the total allowed compensation for goods or services supplied in a period is the full amount of compensation for the goods or services supplied in that period, regardless of whether that compensation is included in the revenue requirement in the same period or a different period. Now, there are differences in timing. If the revenue requirement includes part of the total allowed compensation for goods or services that were supplied in previous periods, or that will be supplied in future periods, or if the revenue requirement for a period does not include part of the total allowed compensation for goods or services supplied in that period. Now, moving on to the measurement proposals. The measurement of regulatory assets and regulatory liabilities is based on expected future cash flows. Throughout this project, we've learned that cash flows arising from regulatory assets or regulatory liabilities are typically stable and predictable. However, in some cases, they may be subject to some uncertainty because of demand or credit risk. In those cases, an entity would estimate future cash flows using either the most likely amount method or the expected value method, depending on which method the entity concludes would better predict those cash flows. Also, the exposure draft proposes that an entity updates its estimates of future cash flows if changes occur, and for that reason, there is no separate impairment test for a regulatory asset. The model also involves discounting all the cash flows arising from a regulatory asset or regulatory liability, including the cash flows relating to regulatory interest. And in most cases, the discounting would be using the regulatory interest rate as the discount rate. There is only one case when an entity would not use the regulatory interest rate as a discount rate, and this is when the regulatory interest rate is for a regulatory asset is insufficient. When there is an indication that the regulatory interest rate provided for a regulatory asset may not compensate an entity for the time value of money and the uncertainty in the cash flows, the entity would be required to estimate the minimum interest rate that would provide such compensation and use that rate for discounting if that minimum interest rate is higher than the regulatory interest rate. Now, the exposure draft proposes that the discount rate established at initial recognition would be kept unchanged unless the regulatory agreement changes the regulatory interest rate. Now, you may be wondering whether the discounting would make the proposals complex to apply. Now, the board consciously tried to keep the discounting proposals simple. In most cases, the regulatory interest rate provided in the regulatory agreement would also be the discount rate required by the proposals. In such cases, the simplest way to determine the present value of the future cash flows at initial recognition would be to sum the future cash flows and deduct the cash flows that result from regulatory interest. This would also hold for subsequent measurement if the regulatory interest rate is also the discount rate and the regulatory interest is recovered or fulfilled in the same period in which it accrues. Only in the case of regulatory assets, an entity has to do the sufficiency test, as I explained earlier. Having said that, because rates are typically designed to support financial viability, cases in which the regulatory interest rate is insufficient are expected to occur infrequently. I will now hand over to Mariela to take you through the remaining main proposals.
Thank you very much, Raghava. Pleasure to participate in this event. And I'm a bit jealous of Raghava because I don't think I'll have the privilege to meet any of my former professors or teachers in any of the events that we will have in this coming period. So really nice that this has been something for you, Raghava. So moving to presentation then. The exposure draft proposes that regulatory assets and regulatory liabilities should be presented in separate line items in the statement of financial position. If an entity presents a classified balance sheet, it would present current regulatory assets and regulatory liabilities and non-current regulatory assets and regulatory liabilities as separate line items in the balance sheet. All regulatory income minus all regulatory expense, which is the net movement between opening and closing balances of regulatory assets and regulatory liabilities, would be presented as a separate line item immediately below revenue. This slide illustrates the presentation in the statement of profit or loss. As we just mentioned, you can see the regulatory income minus regulatory expense line item presented immediately below revenue. And what were the drivers for this? One of the objectives was to keep the presentation proposals simple and intuitive, i.e. to avoid clutter in the primary financial statements. And in addition to this, regulatory income and regulatory expense are not themselves revenue. In the case of regulatory expense, this includes items that affected revenue in the current period, that is, in the recovery of regulatory assets and in initial recognition of regulatory liabilities. In the case of regulatory income, this includes items that will affect revenue in the future, that is, initial recognition of regulatory assets and fulfillment of regulatory liabilities. Consequently, the board expects that presenting regulatory income minus regulatory expense as a separate line item immediately below revenue would provide users of financial statements with the clearest picture of the effects of regulatory assets and regulatory liabilities on the revenue line item. This is in terms of presentation, but for you to know, we'll see later that users would obtain further information about the regulatory income minus regulatory expense line item because the exposure draft proposes that entities disclose a breakdown of this line. We'll discuss this shortly. So moving on to the proposals for disclosure. The overall disclosure objective proposed by the board focuses on providing useful information about the effects of differences in timing on companies' financial performance and financial position. An entity would be required to disclose in the notes information about regulatory income and regulatory expense, which together with the information provided by applying other IFRS standards would enable investors to understand the relationship between the company's revenue and its expenses as completely as they can when there are no differences in timing, i.e. when all of the compensation for goods or services supplied in a period is included in the rates in that same period. That understanding would provide them insights into the entity's prospects for future cash flows. An entity would also be required to disclose information to enable investors to understand the company's regulatory assets and regulatory liabilities. And that understanding would provide investors with insights into how regulatory assets and regulatory liabilities affect the company's future cash flows. So moving now to the proposed disclosure requirements. As we mentioned before, an entity would be required to disclose a breakdown of the amount presented in the line item regulatory income minus regulatory expense. The next slide provides an example of this proposed requirement. An entity would also disclose quantitative information using time bands about when it expects to recover the regulatory assets and fulfill the regulatory liabilities. It would disclose an explanation of how risks and uncertainties affect the recovery of those regulatory assets or fulfillment of those regulatory liabilities. The exposure draft also proposes that an entity discloses information about discount rates used in measuring regulatory assets and regulatory liabilities. Finally, an entity would disclose a reconciliation from the opening to the closing balances of regulatory assets and regulatory liabilities to enable users to understand if the change from opening to closing balance is for reasons other than regulatory income or regulatory expense. For example, changes because of business combinations or disposals of operations. So we have here an example of the specific proposed requirement to disclose a breakdown of regulatory income minus regulatory expense. The board proposes this requirement to enable users to understand the components and causes of regulatory income and regulatory expense. Going back to the very simple example that Anne was discussing previously, the regulatory income of 20 in year one consists fully of additions of regulatory assets. The regulatory expense of 20 in year two consists fully of recovery of that regulatory asset. In other situations, some of the other components and causes of regulatory income or regulatory expense would include additions of regulatory liabilities, fulfillment of regulatory liabilities, regulatory interest income or regulatory interest expense that we have ignored in that simple example, and other items affecting measurement of regulatory assets or regulatory liabilities, such as changes in estimates of future cash flows. We move now to the proposed requirements for measurement and presentation in a very specific situation. In some cases, a regulatory agreement might treat an item of expense or income as allowable or chargeable in determining the rates only once an entity pays or receives the related cash or soon after that, instead of when the entity recognizes the items as an expense or income in its financial statements. In such a case, the entity has a regulatory asset if the entity has a right to add the compensation for an item of expense in determining the rates to be charged in a future period. Or it has a regulatory liability if the entity has an obligation to deduct an item of income in determining the rates to be charged in a future period. The board proposed that the entity measures such a regulatory asset or regulatory liability using the same measurement basis that it uses in measuring the related liability or related asset. An example can be pension costs if the regulatory agreement specifies that an entity is entitled to recover them, but only when contributions are paid in cash. Applying the proposals, an entity would measure the regulatory asset associated with this pension cost using the basis for measuring the pension liability, applying IAS 19. So continuing with the example of a regulatory asset related to a pension liability, the proposals would also require that the entity adjusts the measurement of the regulatory asset to reflect any uncertainty that is present in that regulatory asset, for example, demand risk and credit risk, but that it is not present in the liability, in the pension liability in this case. And it also would require that an entity presents regulatory income or regulatory expense resulting from remeasuring that regulatory asset in other comprehensive income when the remeasurements of the related liability, the pension liability in this case, are presented in other comprehensive income as required by, in this case, IAS 19. Moving now to transition. An entity would apply the proposals retrospectively on transition. This means that all comparative information presented in the first financial statements prepared applying the proposals would have to be restated. A full retrospective application is more useful to users and other approaches because it makes data comparable across time periods and across entities. The board also proposes an optional simpler approach, an optional modified retrospective approach for regulatory assets and regulatory liabilities that were acquired or assumed in a past business combination but continue to exist on the date of transition. I will now hand over to Anne to take you through the board's assessment of the likely effects of the proposals.
Thanks, Mariella. So let's look at the likely effects of these proposals. The exposure draft is not expected to affect all entities with regulatory assets and regulatory liabilities in the same way. The effects of the proposals on an entity's financial statements and also the costs for implementing the proposals would depend on a couple of factors, such as whether the entities are currently recognising regulatory balances and how closely aligned the regulatory requirements are with the proposed measurement proposals. The likely effects on the quality of financial reporting and the benefits of users are summarised in this slide. And we've been talking about these various benefits at various points in our session today. So presenting all regulatory income minus all regulatory expense immediately below the revenue line would make it easier for users of financial statements to understand the effects of regulatory assets and regulatory liabilities. Users would have a more complete understanding of the relationship between an entity's revenue and expenses in a period and also over time. The information produced by the proposals would be more useful than the information currently provided by some entities reporting regulatory balances, because the focus of the proposals is on future cash flows that result from regulatory assets and regulatory liabilities, rather than on the items of expense or income to which the timing differences relate. Because all entities with regulatory assets and regulatory liabilities would apply the same principles, the financial information across entities would be more comparable than is currently the case. And the proposals would likely reduce the cost incurred by users of financial statements for gathering information about differences in timing from other sources. So this slide shows us the next steps and where we are in the process. You know that we issued the exposure draft in January with a 180-day comment period. The deadline for sending in your comments is the 30th of July. And we will be conducting outreach sessions during this comment period. The board will then discuss the feedback from the comment letters and the outreach events. And with that, we conclude this overview of the key proposals of the board's exposure draft. Thank you.
Thank you very much, IASB team. And this was impeccable, amazing. And now people will wonder, was it really so difficult? Because we were all under the impression it was difficult, but now we wonder, is it really so difficult? And I must share something with you now. The total number of participants is 540. 540 are the total number of participants. I'm afraid we are a little short of the time. So without mincing words, I will straightway invite CA Dr. Sanjeev Singhji, Central Council member and Vice Chairman Accounting Standard Board, for the panel discussion. Sanjeev ji, please take over.
Thank you very much, Yignesh Bhai. This was indeed, as you said, a presentation which has simplified the whole concept. And I'm sure that all the participants would have been benefited by the same. I really thank the International Accounting Standard Board people for making such a nice presentation. It's now my pleasure to introduce the panelists for the session now. And I'm aware of the fact that we are late by almost 15 minutes. So I'll try and cover the same as much as possible. I'll first like to introduce Shri A.K. Gautam. Shri A.K. Gautam is a Director of Finance at the NTPC, National Thermal Power Corporation. He's an honors graduate in commerce and a fellow member of the Institute of Cost Accountants of India. He's also a law graduate. He joined NTPC in 1984 and has over 36 years of rich experience in various aspects of finance and accounts. He's one of the few professionals in the country who has deep understanding and vast experience of issues involved in regulatory accounting and impact on profitability, taxation, etc. That is one of the primary reasons that we have selected him as a panelist today. He is also the chairman of Meja Urja Nigam Private Limited and NTPC Vidyut Vyapar Nigam Limited. He's also a part-time director on the board of TTC India Limited, THDC India Limited, and NIPCO. And they also have a CP study circle called Urja CP Study Circle. Thank you very much, Shri A.K. Gautam, and we welcome you today as a panelist. Our next speaker, our next panelist is CA Hemant Goyal, CFO Tata Power Delhi Distribution Limited. He is lighting our houses in Delhi. Hemant brings with him over 3 decades of experience in the power and telecom sector. He had earlier served at various senior level positions in the BSC Rajdhani Power Limited, Bharti Airtel, and Modi Korea Telecom. His expertise lies in putting the financial system and policies in place for new ventures in organizations, restructuring, for strong fiscal controls and good corporate governance in the interest of all stakeholders. He has been an active policy advisor on financial accounting, taxation, etc. to government, professional institutions and regulatory bodies. He is a 1991 batch chartered accountant and a commerce graduate from Rajasthan University. Thank you, Hemant, for taking out time and being here with us today. My third panelist is CA Neena Goyal. Neena Goyal is a partner with T.R. Chadda, firm of chartered accountants based out of Delhi. She holds over 18-year experience in auditing in both public sector companies and private sector organizations. And she has also been auditing several entities in the power sector in the public sector space. She's been handling statutory audit, including those of the listed entities in not only power, but also real estate, insurance, manufacturing, and other services. She's also part of the US GAAP, IFRS, and Ind AS implementation team. She also heads the teams of prestigious internal audit, including the listed companies. Thank you, Neena ji, for taking out time. And, despite, being COVID positive, in fact, I must appreciate that, many of our panelists have either been COVID positive shortly, and they have shortly come out of COVID or they are suffering from COVID even now. But despite that, all of you have stuck to your commitment. Really hats off to all of you. Thank you, Neena ji, for being here. I also welcome CA Amit Chugh. Amit is a graduate from the prestigious Shri Ram College of Commerce. He's a partner with S.R. Bartleby. He has over 19 years of experience in audit and Ind AS conversion and is currently working as a partner with S.R. Bartleby, as I said. He's been involved with ICI on various topics since 2008 as a speaker in various forums. I know that he was a faculty with the Ind AS certification course almost 12 years ago, and he continues to be the same. And member of the technical reviewer of the Financial Reporting Review Board and in various other study groups of ICI. He's an avid cricketer and a marathon runner too. Thanks, Amit, for taking out time and being with us today. Let me start with the first question, and along with first question, I would also like to say that if any of the panelists have any opening remarks also, they may combine the same. In the interest of the time, I would like to combine the opening remarks along with the first question which is being asked to each of the panelists. Mr. Gautam, the proposed definition of regulatory asset and regulatory liability refer to the total allowed compensation for goods or services. So certainly total allowed compensation would also include a profit element and not only the cost. Now, this is different from the concept underlying some of the current accounting approaches for the effects of rate regulation, which focuses merely on cost deferral and not on profit. So do you agree with the focus on total allowed compensation? Over to you, Mr. Gautam.
Thank you, Mr. Singhal. Yeah. As you know that the Institute has already announced the guidance note on rate regulated activities. And at that point of time, NTPC was pioneer in this issuance of this guidance note. So we have implemented this guidance note, also implemented the this NDS 114. Yes, the focus on total allowed compensation is correct, considering the matching principle. Further, in case the profit element is deferred, then the performance of the company cannot be truly reflected in the financial statement. So I would agree that the profit element should also be recognized in the regulatory income in the statement of profit and loss account.
Thank you, Mr. Gautam. So that is a view coming straight away from the preparer of financial statement. Let me ask the auditor of financial statement, Neena ji, what is your view on the same issue, and also any opening remarks on this overall proposal? Thank you.
So on the opening remarks, I would like to say the exposure draft is a very encompassing document which has dealt with all the factors which are relevant for any preparer of financial statement as well as an auditor of financial statements. It talks about, when to recognize, how to measure. Additionally, it has brought in a very important concept which is necessary, and that is the concept of the expected cash flow. Discounting has also been dealt with in the exposure draft. There are elaborate presentation and disclosure requirements, which I'm sure is going to benefit the users of the financial statements to understand the recognition of it. Now, coming to the question on including the profit element, the regulatory agreements, as we see, they all entitle an entity to include the target profit in determining the regulated rate. So in order to meet the matching concept, and because the profit is allowed to be included, it definitely should be included in the recognition of regulatory assets.
Thank you so much, Neena ji. Moving on to Hemant. So again, a preparer's perspective. Hemant, this exposure draft sets out how an entity would determine whether the components of total allowed compensation included in determining the regulated rates charged to customer in a period and hence included in revenue recognized in the period relates to goods or services supplied in the same period or to goods or services supplied in a different period. Do you agree with the proposed guidance on how an entity would determine total allowed compensation for goods or services supplied in a period, particularly when the regulatory agreement provides, and in India there are cases like that the regulatory returns calculated by applying a return rate to a base such as a regulatory capital base, or the regulatory returns on a balance relating to assets which are not yet available for use, or sometime performance incentives. So your response to this particular aspect, including any opening remarks that you may have, Hemant. Over to you.
Sure. I would definitely, though the paucity of the time, I will take one additional minute just to, take you through, because this regulatory asset is very close to the heart of the power sector particularly. It may involve the other sector, but power sector very particularly.
That is the reason, Hemant ji, that there are two people from the power sector in this panel.
So, in the Indian context, there is one thing we need to know. The regulatory assets, are recognized depending on the law, because the law permits to create the regulatory asset in the exceptional circumstances, though not as the business usual. And if the regulatory assets are created, then the law mandates to liquidate it. So on the matching concept, the recognition, as pointed out by Gautam ji and Neena ji, and it includes the profit element. So the accounting wise, more or less, also we are doing the same these days also. So that concept is okay. The only questions which we may see it, practically that regulatory asset is not getting liquidated, though the law mandates it, particularly in the Indian context. So in that scenario, we may see if the regulatory asset is not being liquidated for a longer time, or let's say more than 5 years, 7 years, or 10 years, so should we keep on calling this regulatory asset as a asset, or we need to see if it is not getting liquidated? Because there may be a situation after 5 years or 10 years when if the finally regulated asset is not getting liquidated because of X, Y, Z reason, and there is a sudden shock to the shareholders. So whether calling as a regulatory asset just below the line item of the revenue, it's a fair treatment for all the stakeholders. That's the point why we need to see. Particularly coming on the question number 2. On the question number 2, I would say, yes, I agree with this, that we should recognize the revenue in the for the expenses incurred on the particular period, and also for different period. But different period, I would like to put a disclaimer on it, because in the matching concept, we need to recognize the revenue, but that revenue need to be recognized if the regulation permits, or there is a precedence or the judicial pronouncement for any, any differences in the opinion in the past. There can be only certain issues which were not dealt by the regulatory, agreements, but which comes into the knowledge, or which, comes into the business, for which no regulatory agreement, there is no provision in the regulatory essence. And these issues are decided by the legal forums. So those issues can be covered as a item of the past period or the future period in the income. Otherwise, I totally agree with the point number 2 in the accounting treatment. That's my view on the sector.
Thanks, Hemant. You mentioned about the liquidation of the regulatory asset not happening even for 10 years. Generally, I have seen that normally tariffs, there is a tariff review every 5 years. So normally, that kind of a situation should not be there. But let me check with Amit. Amit, in your experience, have you seen, the regulatory asset required to be carried forward, say, over a decade or say more than a decade? So that's a question to you, flowing from what Hemantji shared his experience. And, I may ask, time permitting, I may ask this question to A.K. Gautamji, also because he has experience over 3 decades. But Amit, what's your perspective on this, and also any opening remarks that you may have?
Thanks, Sanjeevji. So I think first to come to the introduction of this exposure draft, I feel the kind of growth momentum our country is witnessing, and also the kind of importance that is being put upon the power and utility sector, which would actually be the focal point for application of the standard, given its applicability. I think this is very timely in that sense, in providing that guidance on 3 counts. One, it reduces the volatility in the financial statements from year to year. Second, it improves the transparency that goes out to the stakeholders, because right now, though it has been a state concept for a long time, but in today's time, with the kind of private equity disinvestment and the kind of exposure our power and utility companies are getting, the standard was much needed. And third, it improves consistency in comparison. So I guess introduction of this standard is fairly timely. On your specific question, I can answer it more from a renewable sector perspective. I do not, personally, again, from my experience of the entities that have been involved and we have observed, I feel the kind of focus government is putting in, at least nowadays, regulatory assets are getting realized in a timely manner. Because there has been a lot of thirst by the government also in ensuring right impetus to the sector, some of these assets which may have been previously stuck for a longer time are right now getting realized and recovered in a more timely fashion compared to some of the earlier years. And in that sense, some guidance, which is very particularly new in the Indian context, is very welcome from a sector perspective.
Right. Thanks, Amit. And I believe that the proposed standard also talks about discounting or the time value of money in case of, while recognizing regulatory assets and regulatory liability. Though there is how the interest will be computed, there's a slight difference. Mr. Gautam, would you like to add anything on this liquidation period related challenges? If the liquidation period is, say, 10 year, 15 year, firstly, in your experience, in how often it happens, and if it happens, then, the measurement uncertainties would be quite high. Any perspective in brief you would like to share?
Thank you, Mr. Singhal. First of all, what you mentioned that every 5-year regulations are issued. So once the principles are laid down in the regulations so far as the recognition of regulatory assets or liabilities are concerned. So their recognition is, when you are recognized, that should meet the principle of asset recognition. So if I'm answering Hemant's question that they are not getting realized after a period of 10 to 15 years, then definitely if they are not getting realized after a period of 5 years, then definitely we have to see the impairment testing of those assets. That is required. But so far as NTPC is concerned, or more Tower Grid, NTPC means which are governed by the Central Electricity Regulatory Council or the central regulator, these normally they are realized in time.
Thank you very much, Mr. Gautam. Moving on to you, Neenaji. And this question is on the theme measurement and discount rates. So the exposure draft, talks about measuring the regulatory assets and liability at historical cost modified by using the updated estimates of the future cash flows. An entity would implement that measurement basis by applying a cash flow measurement technique. And that technique would involve estimating the future cash flows, including future cash flows arising from regulatory interest, and updating those estimates at the end of each reporting period to reflect conditions existing at that date. Do you agree with this proposed cash flow measurement technique?
The proposed cash flow measurement technique is a very good concept which has been incorporated in the exposure draft. So theoretically, I agree and support this concept which has brought in. But there is a peculiar feature in India in the distribution companies that Mr. Hemant has mentioned already, that these regulatory assets are not being liquidated over a long period of time. So the exposure draft should further address this concern for companies or the distribution companies, especially in India, where this is not being recovered, so that when we use the expected cash flow projection method, there is better guidance on how to use this.
Right, Neenaji. Hemantji, since your response has evoked, number of suggestions and viewpoints. So apart from asking the next question, I would also, ask you that whether impairment testing, which Mr. Gautam said, will take care of this or not. And additionally, I would like to ask you that the exposure draft has proposed that an entity discount the estimated future cash flows used in measuring regulatory assets and liabilities. And except in specified circumstances, the discount rate would be the regulatory interest rate that the regulatory agreement provides. Do you agree with these proposals?
Yeah, Sanjeevji, I would say these are the two aspects, the impairment and the discounting of the future cash flows. I first come on the specific question of discounting on the future cash flows. So I'm talking about the Indian context. I think that is more relevant because we are framing the, accounting standard for the purpose of India. So in India, almost with all the regulators, whether it's a central regulator or the state regulator, there is a concept of carrying cost, which is nothing but the interest allowed by the regulators on the deferment of entitled cost to be recovered in the future, if it has been deferred, or the vice versa liability. So there is a rate which has been prescribed by the regulator. That rate is almost, or I would say in all the cases, is greater than the cost of value, the cost of debt or the cost of money which an entity incurs. So as far as the discounting is concerned, the regulator is very much protecting the cost of the money. So that is being, on the expense side, the interest part keeps on coming, and on the corresponding matching side, the carrying cost comes in, which is nothing as an interest, which keeps on allowed. So there is no question of the discounting of the future cash flows as far as the regulatory asset is concerned, because these regulatory assets are being recognized within the boundary of the law, after the prudence check, and after the legal framework followed by the regulator. So as far as, like, if we compare with the deregulated sector, where the impairment testing is done, either the, some customer goes bankrupt or something happens which is in the control. This is a regulated sector. So once that regulatory assets has been recognized by the regulator following the due process of law, so there is no question of the impairment. That has to be liquidated and the carrying cost is being allowed. So that accounting part is fair. And impairment, I would say there is no, we need to find out some other solution, because impairment happens when it is because of the actions of the customer has gone bankrupt and all that. But because of the XYZ reason, like the interference of some other bodies, if the tariff hike is not happening or the regulatory asset is not getting recovered. So it is not a case of the impairment, because when it was recognized on the matching concept and the accrual concept of accounting, it was very much clear that it will be get recovered and it should be get recovered.
Thanks, Hemantji. Gautamji, I have a question for you. As far as the the regulatory asset is concerned, the exposure draft says it is going to be the regulatory interest. However, in certain circumstances, it could be some other interest rate also if that regulatory interest is not sufficient to compensate. Is insufficient to compensate the entity. But there is no such requirement for regulated liabilities. There it has to be the regulated rate itself. Do you think that there should be a mirror provision for regulatory asset as well as regulatory liability? Or do you think that, no, it's fine for regulatory liabilities, we can have a different yardstick not providing for the exception?
In my view, the regulatory assets and liabilities should not be discounted. However, in case the same is kept in the final standard, then the regulatory interest rate should be the discount rate both for assets as well as for liabilities.
All right. So you are saying that the parity should be maintained and an exception should not be there.
Yeah.
Point well taken, sir. Moving on to you, Amit. In some cases, a regulatory agreement, and this is, pertains to the theme items affecting regulatory rates only when the related cash is paid or received. And this is, this may be peculiar to India, but you never know, this will be prevalent outside India as well. So in some cases, a regulatory agreement includes an item of expense or income in determining the regulated rates in the period only when an entity makes that payment or receives the related cash or soon after that. Instead, and which is different from the accrual basis, that is as to when you are recognizing it. The exposure draft proposes that in such cases, an entity would measure any resulting regulated asset or liability using the measurement basis that an entity would use in measuring the related liability or asset by applying the IFRS standard. And more often than not, an IFRS standard may give us an answer which will say on an accrual basis. So do you agree with these measurement proposals when the items of expense or income affect regulated rates only when the related cash is paid or received?
Right. So Sandeep, you've absolutely right. So this is actually a departure from the usual IFRS principles or even the principles that have been laid out in the exposure draft itself. And that in a way makes it as an exception from the general principles one would follow. But of how it has been defined in the exposure draft and the kind of examples that are given, I would believe that this is the right treatment given the uncertainties that are involved with some of these aspects. And considering those uncertainties, it is more appropriate to account for them on a cash basis rather than on an accrual basis. So the way it is drafted and the kind of examples that have been brought out make it a better representation of such assets and liabilities.
Right. Thanks, Amit. Ninaji, moving on to you. Do you agree that the entity should present all regulated income minus all regulated expenses as a separate line item immediately before revenue? If yes, then it's fine. If not, then what do you suggest? Ninaji, you're on mute. Kindly unmute yourself.
I'm sorry. It is a part of revenue because whatever regulatory income is being accounted or expense is being accounted, it is definitely for a clear reflection of revenue. So I agree that it should be shown as a separate line item below revenue.
Right, Ninaji. And I'm taking this question further to you. This question to Ninaji was on regulatory income and expenses. I would like to ask this, regarding regulatory interest income and regulatory interest expense, presenting them within the line item immediately before revenue. Do you agree with this approach? If not, then what's your suggestion?
Sure. And before that, I just have a small suggestion on the interest rate also. So for the discounting rate, again, unlike the general principles in IFRS or Ind AS, wherein it is the market reflective interest rate, here the exposure draft specifies the discount rate to be the regulatory rate of interest. So I feel some flexibility could be given to the enterprise to better reflect that discount rate, and a market rate could also be used there. So that's one suggestion. More particularly on your question, as Ninaji said, and I feel it is a right representation. However, here again, there might be an instance, if I go by the principles of say IAS 1, which says that disaggregated information needs to be given if it better reflects the entity's financial performance. And here also, if rather than disclosing in a single line item, if an entity believes that disaggregating into interest, revenues, and expenses separately gives a better representation, then that allowance need to be given to enterprises to disclose it in that manner.
Right, Amit. Thanks. Taking the next question to you, Hemant. When the measurement proposals apply and result in regulatory income or expense arising from remeasuring the related liability or related asset through OCI, other comprehensive income, the exposure draft proposes that an entity would also present the regulatory income or regulatory expense in other comprehensive income. What's your view on this? Is it okay, or do you have any other suggestion?
No, sir, that's perfectly all right. The treatment which has been proposed in the draft, I agree with this.
Thank you, Hemant. Thank you for the pointed answer. In fact, the answers of all the panelists have been really so sharp that we've been able to bridge the overrun which we're having. I'll ask last two questions, one to Ninaji and one to A.K. Gautamji. Ninaji, are the proposed overall and specific disclosure objectives and disclosure requirements worded in a way that would make it possible for preparers, auditors, regulators, and enforcement bodies to assess whether information disclosed is sufficient to meet those objectives? And at the same time, do you think there's going to be an information overload?
No, I feel that the information which is required by the exposure draft is information which is essential for the readers of the financial statements, and it would give a good insight to the readers of the financial statements on the account.
Thank you, Ninaji, again for the pointed answer. Yes, to A.K. Gautamji, while you can respond to this question as well, I mean, if you wanted to add anything, and also your views on if you see any practical challenges in the implementation of this exposure draft when converted to a full IFRS in India?
So, Singalji, before going to these challenges, I would like to request on the disclosure aspect, which has been shown in this presentation by IASB. The entities which have already applied Ind AS 114, whether when they will be implementing the new standard, whether they would also require to restate the openings also. Because I think in that they should be exempted for restatement because they have already applied the Ind AS 114. So there should not be much of a difference. Only there will be just means presentation change would be there. In the current standard, Ind AS 114, the regulatory income is appearing after the taxes, but now you are proposing it will come after the revenue. So that may please be reviewed by the IASB. Now coming to the other aspect which you just raised, the discounting of regulatory assets and liability, it will be a challenging area. As Hemant was also mentioning, although in most of the cases, regulator defines the rate of interest, but nowadays, because of certain situations, these rates are being changed. So the timing of cash flow cannot be reliably estimated, as the same is dependent on the actions which is to be taken by the regulator. So it may be explored that the existing provision in this regard may be kept in the standard.
Thank you very much, Gautam ji. And before I come to the IASB staff to respond to some of the issues, I know that Raghav Trimala has also raised hand, but in any case, I'm going to come to the IASB. I think Amit Chuk has raised his hand. Amit, do you want to say anything?
Sanjay, may I take a minute if you permit?
Yeah. Absolutely, Hemantji. So once Amit has spoken, certainly you can add.
Thanks, Sanjeevji. So I have a couple of suggestions from a disclosure perspective. I think the first suggestion that I have is for power and utility companies, regulatory income might be a significant portion of their income. And as 115 or IFRS 15 defines revenue as revenue from ordinary course of business activities. Now, taking and differentiating regulatory income completely out of revenue might lead to failure of certain covenants on part of these entities because it might be a significant chunk of their revenue. So some reference could be laid to these entities in terms of how they can disclose, because eventually this is also revenue from ordinary course of their activities. And
I think that's a very valid point, Amit. Yes, please go ahead.
And second, we have touched upon a lot of aspects in disclosure, and there is definitely not overflow, and Marila really, summarized them well. One thing that I feel can be added is we are focusing a lot on disclosure, but how the cash flow impact of all of these activities is to be dealt in the cash flow statement is somewhat not completely clear in the exposure draft. Some of these items may have a cash flow impact as well, and hence how that is to be dealt in the cash flow statements need to be more clearly brought out in the standard if we are eventually intending to come up with it.
Thanks, Amit. I think very valuable. I think Hemant, you also wanted to take a minute.
Yeah, I have two suggestions for the consideration of the IASB. Maybe looked into it. One is that the provision of some items should not be forced to be made in the accounts if the regulatory agreement does not permit, or if the regulatory agreement is not permitting, then it will create a mismatch in the tax. For easy understanding, I can give you one example to make this discussion easy. Like on the deferred tax, there is no explicit regulatory regulations available. But to comply with the accounting standard, deferred tax is required to be created. But the regulatory agreements are silent. So on the accrual concept, if the deferred tax get included as a part of the regulatory asset, then the tax on the deferred tax gets created despite no provision in the regulatory agreements. So that aspect may be looked into. That's one. Number two, because the recovery is not certain because of whatsoever reason, the institute can explore or IASB can look into by the time the recovery happens, is it possible to disclose the regulatory deferral account below the PAT? So the shareholders also get the information that this is the total amount or this is the profit which has been generated but has not been offered to tax because this has not been realized. And the last line of the P&L, there is a question mark till the time this gets realized. So the purpose of the shareholders is met, the purpose of the tax is met, and the purpose of accounting standard or the disclosure requirement is also met. Maybe looked into. These are some suggestions.
Thank you, MNG. Personally, I've seen that even deferred tax gets recovered in the form of the future tariffs. So actually, this concept was not there a few years ago. So probably that's the reason. And this particularly PNU sector is fairly old in India and everywhere across the world. And that time deferred tax concept was not there. So maybe that's why it's not been specifically mentioned. But in some of the power companies that I have audited, I've seen that this is allowed to be recovered from the consumers. Point well taken, MNG. I now move on to the end. Before moving on to my IASB staff, I would like to sincerely thank all the four panelists, A.K. Gautam ji, Hemant ji, Amit Chugh ji, and Neena Goyal ji for sparing their valuable time, responding to the questions very nicely, and also giving number of suggestions. There are more than 6 suggestions which have been received. So now I move on to the IASB team to respond to some of the specific suggestions. For example, whether the revenue is to be recognized if the regulation permits, or the regulated assets and liabilities should not be discounted, or if they are to be discounted, they should be discounted at the regulatory rate without permitting any exceptions. And a very important point on the transitional provisions, because in India, when we have converged with IFRS 14, the existing IFRS 14, we already have a history of the rate regulated entities guidance note. And then obviously Amit Chugh's issue that the regulatory income in certain cases is very significant, not considering it as an ordinary revenue, could pose significant challenges in terms of showing the operating profit, showing the cash flow impact in the cash flow statement, and finally, whether a provision should be necessary if the regulatory agreement does not permit. So if IASB staff can throw light on some or all of these aspects, I think that will be very useful.
Thank you, Mr. Singhal. I was actually planning to answer only a few factual questions and not respond to all the views, because we are here not to sell the exposure draft, but to hear the views being expressed on the proposals. So I'll probably pick on just some of them, more factual sort of questions. So the first thing on IAS 12, there is a section in the application guidance that talks about that discusses the interaction of the proposals with IAS 12. So it might help to specifically look at that interaction section and see if the board has sort of adequately covered the interaction. So it is paragraph B41 to B46 in Appendix B. So that's on IAS 12. Now, coming to the cash flow statement, the changes in regulatory assets and regulatory liabilities are primarily non-cash movements. The final cash inflows or the cash outflows come through the revenue line item, when the amounts are charged to customers. So the cash flows are anyway coming through the revenue line item. And regulatory income or regulatory expense as such is a non-cash change. So there are a few paragraphs in the effects analysis section of the basis for conclusions in which we do explain what could be the potential impact on the statement of cash flows. I mean, as of now, if an entity presents cash from operating activities using the indirect method, all that I can think would happen is you'll start off with profit after tax or before tax or whatever that line item is, and then add back regulatory income and regulatory expense as a non-cash item. So I mean, at least in the effects analysis, we have some discussion on the impact on statement of cash flows. Happy to consider your comments if you think the discussion is inadequate. But I think more importantly, the point I wanted to make was matching concept was not at the heart of the proposal. So when developing these proposals, the board was not trying to use matching concept as the basis for coming up with these proposals. I think Mr. Goyal made a useful comment there, saying that you're not just matching, but then you're only recognizing things that the regulatory agreement has allowed. So that's the reason, the definition of regulatory asset and the regulatory liability ties back to what the regulatory agreement allows an entity to charge in the future or deduct from rates in the future. So it is not true to say that the whole model has been built on the matching concept. But of course, the application of the proposals and how the numbers get reported, you might see the outcome. There might be matching in outcomes, but then matching concept is not certainly at the heart of the proposals. So I think, and again, in relation to discount rate, as we said when we were discussing the measurement proposals, that the board envisaged the regulatory interest rate to be the discount rate in most of the situations. And that's also one of the reasons to keep the discounting model a bit simple rather than requiring entities to establish a market participants discount rate. So it's only in the case of regulatory asset, the board proposed that an entity needs to assess whether the regulatory interest rate is sufficient compensation or not. But even in that instance, the board is of the view that because the cash flows are fairly stable, the regulatory agreement is, the regulators generally make sure that, the company is financially viable and the cash flows are stable. We don't expect, those situations in which an entity would not use the regulatory interest rate to be quite frequent. So I think there have been some useful views in the panel discussion that we could take back. And Mariela, do you have anything to add at this stage, or?
Yes. So if we still are on time and we may.
Yeah. Please
okay,
go ahead.
So, thank you very much. Only a
few 2-3 minutes. We can spend 2-3 minutes. Yeah.
All right, thank you so much. So there's been a few comments on the difficulties of recover some outstanding amounts on regulatory assets. Some other panelists have said that they have seen that recently the situation has improved and they are being recovered timely. So I just wanted to remind the proposals for capturing impairment issues in those balances. It is that an entity would need to update its estimates of future cash flows. And that means that recoverability uncertainties would need to be captured in that estimation of future cash flows. And that's why there is no separate impairment test. So I think that's an important point to be made. So there was a gentleman saying that he would rather not discount, but if it had to discount, then he would rather then use the same regulatory interest rate for regulatory assets and regulatory liabilities. And this is exactly the proposals for the board. So in most cases, the regulatory interest rate will be the discount rate for both, for regulatory assets and regulatory liabilities. And this is important because the board did not think that an entity should determine what is the exact rate that would reflect time value of money and uncertainty in the cash flows. The board assumed that in most of the cases, the regulator is providing a rate that sufficiently compensates or charges the entity for time value of money and uncertainty. And therefore, if there was a surplus or a deficit on these, the board considered that it would rather allow entities to recognize those over time than require entities to determine the exact discount rate that would reflect risks and uncertainties and then recognize a day one gain or loss. So the board said, no, use the regulatory interest rate as a discount rate. By doing so, entities would be recognizing regulatory interest income and regulatory interest expense over time. And there was only one case when the board thought, well, for regulatory assets, when the rate being provided by the regulator does not even compensate the entity for time value of money and uncertainty, this is when the only case when the board thought it is worth understanding what would be that minimum interest rate and use that minimum interest rate for discounting. There was another comment about disaggregating line items in accordance with IS1, only just to mention that the ED would not prevent an entity to do so if the entity considered that doing so would better reflect the financial performance or understandability of the financial performance of the entity. So the proposed requirements in the ED, as I said in the presentation, aim to avoid clutter in the financial statements. However, they talk to IS1, so an entity can still apply IS1 and include more line items if it thinks that that's appropriate. And I think, well, several covenants, that was a very important actually comment, and I think we need to take it with us. Why the board did not consider that the regulatory income and regulatory expense needed to be adjusted or included in the revenue line item is because the board wanted to keep revenue line clean and reflecting IFRS 15 and have the reflection of these differences in timing in a separate line item. And as you might know, so yes, you might have companies that all of their activities are regulated, but you might also have other companies where they might have activities that are regulated and activities that are not regulated. So having those amounts in that single line item would not give users the civility of what we are really trying to do with this project, which is really understand what are the effects of this regulatory income and regulatory expense, differences in time in the financial statements. So
Mariela, on this point, I would like to ask you that, will it be possible to show, say, revenue from operating activities and then revenue from the regulated or say the regulatory income as an operating income itself? Because that is the key concern.
Okay, no, it is operating. So the nature would be operating. This is a proposal. Yes.
I mean, as we also said, Mr. Singhal, regulatory income, regulatory expense is itself not revenue, right? So those represent impacts on future revenue. So that's the reason the board couldn't propose requiring regulatory income, regulatory expense to be shown within the revenue line item. And so that's the proposal is to present it immediately below revenue. And also just to add to Mariela's point about disaggregation on the face of profit and loss account, please note that if disaggregation was important, I think the proposal would still say that any disaggregation should be immediately below the revenue line item. So you can further disaggregate, but then all those additional line items have to be presented immediately below revenue and not scattered across the statement of profit or loss. So that's something I just wanted to make so that there's no further confusion. Yeah.
No, this is very helpful. With this now, I would like to hand it over back to Yagnesh Bhai to invite our very own AOSSG chairman to introduce and invite our very own AOSSG chairman and the former chairman, Accounting Standard Board and a Central Council member for 3 terms, CA Dr. S. Gizavare. Over to you, Yagnesh Bhai.
Yagnesh, before you can come in, and I have a small observation. As far as the transition provisions are concerned, I would like to understand, at least in the BC when it is finalized, as to why a modified or retrospective cumulative catch-up transition method has not been considered. Given the size of entities who are involved and the fact that it is going to affect only one particular year, in terms of ease of implementation and cost of implementation, I know that comparatives for 1 year will not really match, but I think IASB has done an excellent job in allowing the modified retrospective approach for IFRS 15, IFRS 16. I would encourage that we should consider it for this IFRS 14 also, considering that the existing one was an interim standard and people are moving from an interim to a final standard. It will be extremely helpful, particularly from the cost perspective. And most of them are public interest entities who are listed entities who have to apply it within a short period of time. So I would strongly encourage that we should look at a modified cumulative catch-up approach. Thank you.
Okay.
Over to you.
Thanks for all those comments. We'll take those away. Thank you.
Thank you, everybody. And I must share something. The numbers are rising, and the numbers are now is 573, a big audience for IASB team and ASB panel discussion. We must appreciate something that 3 out of 14 members of IASB who are from the East Asia and Australia are there full time during this outreach program. And I'm wondering that it's almost 10:45 in Australia and about 8:35 to 9:35 in the East Asian country, and they are still on and active with the same vigor and forward. Appreciate their commitment and dedication to the accounting fraternity. IASB team, kudos to you, and we all appreciate you for your commitment. It looks like that no one is interested to leave. The number is increasing. And Dr. Sanjeevji, once again, I realized today that asking a pertinent question is not anyone's cup of tea, except the one who knows the subject very well. You have the knack of asking to the point, and this was aptly reciprocated by the learned panelist. IASB team has made it easy, and the panel discussion has made the subject easier.
deliberations. I'm really thankful to all of you. Actually, when Raghava was talking about, I said his master's voice. His master MP Vijay Kumar and Raghava, I can say that you talked so clear worded without any confusion. Thanks for that. And that's why I say your master's voice. Anatarka has given us the problem and a solution. And that's right. And you will agree with me that we will try to find out the solutions to the maximum possible extent. Some problem is going to remain. When there was a discussion about taxation, in India, we had a fear about taxation when Ind AS, that is IFRS converged standard, was being implemented. In a similar manner, when there is an accounting standard or there is an IFRS or the global standard, it cannot talk about the taxation. However, when the Mariana talked about that revenue line is clean and the special line item is shown separately, we'll have to try with the taxation authority that special line item is not an income. But friends, believe me, it is not only an income, it is plus and minus. There are pros and cons. And the taxation problems we are going to sort out on its usual way with reference to tax laws. Raghava has very rightly and aptly talked about that unless and until three primary conditions are satisfied about the regulatory agreement, the basis of agreement, and very important, it creates a timing difference. And he also talked about what are the items of totally allowed compensation for our clarity. And that has given a lot of clearance and understanding. MPB, you raised very right issue. I had written down. Fully retrospective is understandable. But as a practical solution, and especially in our jurisdiction, as we are already following a guidance note issued by ICAI in order to resolve this problem, probably the difference is very little or impact will be little, and probably this is only for a period of 1 year, one-time adjustment. So I really request IASB to consider this suggestion. Raghava very rightly talked about and appreciate that IASB team is here to hear the views, not to market the exposure draft issued by IASB. That's right, because this is exposure draft. You have every right and they have every obligation to hear you, understand you, and try to modify the exposure draft and convert into the real standard. Dr. Sanjeev Singhal has very rightly asked various questions, and we could get the answers also. But it's a thinking. 100% perfection is impossible, and therefore we have to try to solve the maximum possible extent. I'm really thankful to the IASB team, that is Anatarka, and the technical staff members Mariela as well as Raghava. I really appreciate the presence of Jin Chow, the IASB member, as well as Rika Suzuki, who have joined this as a viewer, and you have really tried to understand what are the problems and what are the issues for implementation. I am really thankful to all the panelists who has given apt answers, and Yagnesh, you rightly said that this type of exposure draft, the panelist has to be expert from a particular field. And Dr. Sanjeev Singhal and the IASB team has found out those members who have the practical exposure, who know the problem, they know where the shoe pinches, and for that purpose, they tried to give the answers also. IASB will consider their presentation. Very nice. I think this was one of the best outreach event, MP Vijay Kumar. I'm thankful to our Honorable President Nihar Jambusaria, as well as Vice President Dr. Debashish Mitra, and both the Chairman and the Vice Chairman of the Accounting Standard Board, MP Vijay Kumar and Dr. Sanjeev Singhal, all the IASB members and the staff, and Yagnesh, you have done your best as ABOC. Right. Now, after ABOC, what is the promotion? That we'll have to find out. And the next time, we'll have to think of that instead of ABOC. Very important is thankful to all the viewers and the participants whose number is great. I appreciate. That means this standard is of a great importance, especially where there are rate regulated entities are there. So thank you all for your participation.
The numbers are 578 now.
Very good, very good. Right. So my dear friends, I am concluding now. Follow COVID-19 discipline. Stay safe and remain healthy. All the best.
Thank you, sir. Thanks, Agnesh, for wonderfully hosting.
Thank you very much.
Thank you, Agnesh.
Thanks to the staff of ASB, SN Gupta, Parminder, Ruchika and all, Nikita. Thank you all. Thanks to the technical staff.
Thank you, technical team. Back office.
Thanks to all the panelists. Gautam, Hemanji,
very good.
Amit, Neena, thanks a lot. Sanjeev, you are awesome as usual. Thank you.
Thank you, Vijay. Thank you.
Gautam, sir, thank you, sir. Thanks for your
Thank you, Sanjeev. Well done.
Thank you, sir. Thank you, sir. Thank you.
God bless.
Bye.